I wish this was a calm update. I really do. This was supposed to be one of the quietest weeks of the year. Western markets were closed. Trading desks were empty. Liquidity was supposed to be dead. But while most people were celebrating, something critical was already unfolding. Because while the US markets were offline, silver didn't stop moving. It simply moved somewhere else. In Shanghai, physical silver was trading near $80 an ounce. At the exact same time, US screens were still showing prices in the low 70s. That's not a rounding error. That's not volatility. That's a structural arbitrage gap in a market that is not supposed to have one. In a healthy global market, gaps like this don't last. Banks close them, funds exploit them, metal flows until prices align. But that didn't happen. And when arbitrage stops working, markets don't stabilize. They fracture. This is where most people get confused. They look at the chart and think this is about price. It isn't. This is about control. For decades, silver pricing was dominated by paper markets, futures, derivatives, leverage. Physical demand mattered, but it stayed in the background. That balance has now shifted. China didn't suddenly wake up this year and decide silver was important. They spent decades quietly building control, not just over mining, but over refining and processing. That's the part most people miss. China controls roughly 60 to 70% of global silver refining capacity. Silver mined in Latin America, Africa, and even parts of Asia often passes through Chinese infrastructure before it ever reaches the market. That makes China the gatekeeper. And now, starting January 1st, 2026, the gate is no longer open by default. China's new export controls don't look dramatic on the surface. There's no outright ban, no emergency announcement. Instead, there's a licensing system. Only large producers, those refining more than 80 tons annually, can export freely. Smaller refiners are effectively locked out. This changes everything because it doesn't stop supply. It redirects it. Silver that would have flowed west now stays east. Domestic Chinese industry gets priority. Global supply tightens, quietly, structurally, and permanently. And this is happening during Ghost Week, the thinnest trading window of the year, when senior risk managers are gone, when liquidity providers pull back, when markets lose their shock absorbers. That timing is not accidental. It's why small orders are causing large moves. It's why prices are gapping instead of grinding. And it's why this move feels unstable. This isn't a rally yet. This is the system realizing it has a problem. To understand what's happening now, you need to understand how power actually works in commodity markets. It's not about who mines the most. It's about who controls the bottlenecks. China is the second largest silver miner in the world. But mining isn't where their real power comes from. Refining is. Raw silver concentrate is useless until it's processed. Industrial-grade silver requires specialized infrastructure, chemistry, and scale. China built that capacity quietly over decades. While Western countries focused on financial markets, China focused on physical supply chains, solar panels, EV batteries, electronics, data centers. All of these industries require silver, not optionally, not theoretically, but physically. And China dominates them. Over 80% of the world's solar panels are produced in China. Newer TOPCon solar cells use significantly more silver than older designs. Electric vehicles use roughly 50% more silver than internal combustion cars. Battery management systems, power electronics, charging infrastructure, all silver dependent. And now add AI, high-performance servers, data centers, advanced chips. Silver is the best electrical conductor available. There is no substitute that performs at the same level. So when China restricts exports, they aren't trying to crash the market. They're doing three very specific things. First, they're securing domestic supply. Second, they're pushing global prices higher to benefit Chinese producers. Third, they're creating geopolitical leverage. The US understands this, which is why silver was added to the critical minerals list in November. But acknowledgement doesn't equal preparation. The US imports between 67 and 80% of its silver. Mexico supplies some. China supplies more, directly or indirectly. Domestic production cannot scale quickly. New mines take 5 to 10 years to come online. That means supply cannot respond to price. So when demand rises, pressure builds, and pressure doesn't show up as headlines first. It shows up as delivery stress, as dealer shortages, as rising premiums, as broken arbitrage. That's exactly what we're seeing now. Shanghai prices reflect physical reality. COMEX prices reflect paper assumptions. And during Ghost Week, those two worlds stop communicating. This is how control quietly shifts. Ghost Week is not quiet. It's dangerous. From December 26th to January 2nd, markets operate on skeleton crews. Senior traders disappear. Liquidity providers pull back. Risk desks flatten exposure. What's left are algorithms and junior staff. This does not reduce risk. It removes shock absorbers. In a liquid market, large orders get absorbed. In an illiquid market, even small orders cause violent moves. That's why silver jumped multiple dollars in a straight line. There were no sellers. At the same time, US bullion dealers began pulling inventory. Not because of Christmas, because of risk. If you sell silver at 72 today, and it gaps to 80 when markets reopen. You can't restock, so the rational move is to stop selling. That's how physical supply disappears before charts reflect it. This is what a supply strike looks like. Miners wait. Refiners wait. Dealers wait. Buyers don't. Industrial demand is inelastic. Factories don't stop because price moved. They secure material at almost any cost. That's why Shanghai keeps paying up. And that's why arbitrage isn't fixing the gap. Because arbitrage requires metal to move. If metal can't move, or doesn't exist where it's priced, arbitrage becomes risk, not profit. That's when markets stop functioning normally. When people hear the word crash, they imagine prices falling. That's not what this looks like. A real silver market failure doesn't show up as lower prices. It shows up as prices you can't transact at. Screens update. Quotes exist, but inventory disappears. Two prices emerge. One real, one imaginary. That's what we're approaching. This isn't a bubble driven by hype. It's a shortage driven by structure. 4 consecutive years of supply deficits. Hundreds of millions of ounces consumed beyond production. London vault inventories down sharply. Paper markets masked this reality. Until they couldn't, silver always exposes stress first, because it sits at the intersection of money, industry, and logistics. It must be delivered. It must be consumed. It cannot hide behind policy. That's why it speaks early. Not because it predicts the future, but because it reacts to the present faster than narratives can adjust. This is not about chasing price targets. 80, 90, 100. Those numbers will flash across screens, spark excitement, then fade away. That's not where the real story is. The real story is structure, and structurally, something fundamental has shifted. Paper control is no longer absolute. Physical demand is no longer patient. And trust, the invisible glue holding this system together, is thinning. When those 3 forces move at the same time, markets don't adjust politely. They reprice, sometimes slowly over months, sometimes violently in days, but always, eventually. This isn't financial advice. This isn't a call to buy or sell anything. It's a signal. And if history teaches us anything, it's this. Signals matter most before the headlines catch up, before the crowd arrives, and before explanations replace warnings. If you want to stay ahead of those moments, not react to them after the fact. Make sure you're subscribed, because what's happening in silver right now is bigger than a price. And this story is far from over.